Hello everyone, I am Dr. Jamuna, Associate Professor of Management from Tecnia Institute of Advanced Studies. Today I am going to deliver a lecture on weighted average cost of capital. What is it? Weighted average cost of capital is the average rate of return a company expects to compensate all its different investors. The weights are the fraction of each financing source in the company's target capital structure. So, how it works? Let's see that. Here is the basic formula for weighted average cost of capital, that is WACC is equal to E by V into RE plus D by V into RD into 1 minus T. E is the market value of the company's equity and D is market value of the company's debt. V is total market value of the company, that is E plus D. Then RE is cost of equity. RD is cost of debt and then T is tax rate. A company is typically financed using combination of debt, that is bonds and other things, and equity, that is stocks and other things. Because a company may receive more funding from one source than other, we calculate a weighted average to find out how expensive it is for a company to raise the funds needed to buy buildings, equipment and inventory. Let's look at an example. Assume newly formed corporation ABC needs to raise rupees 1 million in capital, so it can buy office buildings and the equipment needed to conduct its business. The company issues and sells 6,000 shares of stock at rupees 100 each to raise the first rupees 6 lakhs. Because shareholders expect a return of 6% on their investment, the cost of equity is 6%. Corporation ABC then sells 400 bonds for rupees 1000 each to raise the other 4 lakhs in capital. The people who bought those bonds expect a 5% return, so ABC's cost of debt is 5%. Corporation ABC's total market value is now 6 lakhs equity plus 4 lakhs debt, that is rupees 1 million, and its corporate tax rate is 35%. Now, we have all the ingredients to calculate corporation ABC's weighted average cost of capital. Weighted average cost of capital is equal to 6 lakhs divided by 10 lakhs into 0.06, that is 6% plus rupees 4 lakhs divided by 10 lakhs into 0.05 into 1 minus 0.35, that is equal to 0. If you calculate, you will get 0.049, that is 4.9%. Corporation ABC's weighted average cost of capital now is 4.9%. This means for every rupee 1 corporation ABC raises from investors, it must pay its investors almost rupees 0.05 in return. Now, why the weighted average cost of capital matters? It's important for a company to know its weighted average cost of capital as a way to gauge the expense of funding future projects. The lower a company's weighted average cost of capital, the cheaper it is for a company to fund new projects. A company looking to lower its weighted average cost of capital may decide to increase its use of cheaper financing resources. For instance, corporation ABC may issue more bonds instead of stock because it can get the financing more cheaply. Because this would increase the proportion of debt to equity. And because the debt is cheaper than the equity, the company's weighted average cost of capital would decrease. So, I hope you understand the concept of weighted average cost of capital. Thank you so much.